They told you the fastest way to freedom was to throw every spare dollar at your mortgage. They lied. Everything you think you know about paying off your mortgage is about to get flipped on its head. If you want to pay off your mortgage faster, the counterintuitive truth is to stop trying to pay off your mortgage faster. This isn't your grandpa's finance advice. This is the disruptor's code in action, rewriting the rules of the game. Get ready to unlearn the big lies that have kept you broke and discover a smarter path to true wealth and freedom. I want you guys to buckle up as I've been teaching this for more than 20 years. As I've been teaching clients wealth strategies, I started to become a real estate lawyer, the tax codes, and I've been speaking around the world for more than 20 years. And I learned quite a few things from billionaires and their wealthy strategists and lawyers, and the best strategies that can move the needle. The things that society won't teach you, that they'll cost you thousands of dollars in paying somebody hourly to learn those secrets. Welcome to the Carlos Inspire Show. I'm Carlos Inspire, your host, and today's episode is titled, How to Pay Off Your Mortgage Faster, the Smart Way. Before we dive into the strategy, let me share where my unorthodox mindset comes from. I wasn't born with a silver spoon. At 7 years old, I was out on the streets of Brazil selling bread at dawn, a little boy hustling to help put food on the table. I can still remember the smell of the fresh bread with the coconut on top mingling with city dust, the weight of a basket in my tiny hands and the back of my bicycle. I felt every ounce of responsibility and hunger, not just physical hunger, but a hunger for a better life. That's where I got my immigrant hustle and grit. Selling bread taught me the value of every coin. It taught me how to turn one loaf into two, two into four. I learned to multiply what little I had, to think in terms of opportunity, not just survival. The mindset of turning pressure into power started on those streets, my friends. I realized money could work for me even when I was a kid, figuring it out how to upsell an extra roll. Fast forward to today, I apply the same scrappy contrarian thinking to building wealth, not just for myself, but for thousands of clients. I question every rule they try to hand me. And guess what rule I found totally backwards? The one about mortgages. Let's talk about the big lie. Send extra payments to your mortgage and you get rich faster. Society worships at the altar of the debt-free as fast as possible. We are told the American dream is to own your home outright. Burn the mortgage papers, pop the champagne. Don't get me wrong. Being debt-free feels great emotionally. But chasing that feeling too soon might be costing you real wealth. Here's the harsh truth. Sending the extra money to your mortgage is often a slow lane to wealth. It's a comfortable lie that keeps you house rich but cash poor. Think about it. Every extra dollar to the principal is a dollar locked in your walls. You can't use it for emergencies. You can't invest elsewhere. It's stuck. All you get in return is a slightly shorter long term and interest savings is spread over decades. Meanwhile, life is happening now. Opportunities to grow your money are passing by while your equity just sits there, doing nothing to increase your home's value. It feels safe to prepay your mortgage, right? But feeling safe and being financially free are two different things. We'll get into psychology in a minute. Tony Robbins has something to say about that. But let's lay out the lie plain and simple. Your home's value won't suddenly skyrocket just because you paid off the loan faster. The market goes up 5%, it goes up 5%, whether you own 0% of the home or 100%. You don't get a bonus for having more equity. All you did was take liquid cash out of your pocket and bury it inside the bricks and drywall. I know this challenges every finance guru on TV and the radio tells you. But those same gurus often are living paycheck to paycheck, worried about a medical bill or a job loss. Liquidity, having cash or accessible funds, is king. In traditional payoff, the mortgage early advice kills your liquidity. It's time to slay the sacred cow. Let's apply some Ray Dalio style thinking here. Dalio talks about first order consequences, the immediate results of a decision, and second order consequences, the ripples and long term effects. First order thinking on mortgages is shallow. If I pay it off sooner, I save interest and I am free of payments. Good one. Well done. That's the knee jerk logic everyone sees. But second order thinking asks, what then? What do I give up by doing this? What are the ripple effects 5, 10, 20 years out? So you paid off your mortgage early. Then what? Did that decision maximize your wealth or just gave you a pat on the back? Here's the second order reality. Locked in equity, every extra dollar to the mortgage is a dollar not earning elsewhere. It's opportunity cost. You could have invested that dollar, you could have earned it compound and working for you, but now it's stuck as equity, which earns what? 0% return. Reminder, your house will appreciate or not, regardless of how much equity you have. Equity is not ROI. Lost liquidity. You can't easily get the money back without borrowing it via a HELOC or refinancing or selling the house. If an emergency strikes, job loss, medical issue, amazing investment opportunity, you might be house rich, but cash strapped. That's a dangerous place to be. I've seen families have to refinance or take high interest loans in desperation because all their savings went into a house that they can't slice it off a piece of when needed. Inflation and cheap debt. Here's something the average person misses it. Inflation is a debt friend. If you have a fixed low interest mortgage, inflation and time are quietly eroding the true cost of that debt. You are paying tomorrow's mortgage payment with inflated dollars that are worth a little less. That's a win for you. So the second order effect of not paying extra is that over time, your debt effectively costs you less in real terms. Why rush to pay back cheap money in today's expensive dollars? Think about that. In Ray Dalio's terms, first order thinking says, that bad, kill that. Second order thinking says, that at a 3% while my money could make 6% plus elsewhere equal smart leverage. It sees the bigger picture. Use time and interest rates to your advantage. Don't just solve the immediate equation of that gone equal good. We have to play chess, not checkers, with our finances, my friend. I often say, don't be the chess player, become the board. Enter Robert Kiyosaki and the concept of good debt versus bad debt. This was a game changer for me when I learned it and went even in depth on this. Kiyosaki famously said, your house is not an asset. It ruffled a lot of feathers, but here's what it meant. Your personal residence doesn't put money in your pocket each month, so by his definition, is not an asset, it's a liability, at least until it's producing income or until you sell it off for a gain. Now, not all debt is created equal. Bad debt is high interest, used to buy things that go down in value or produce no income. Think credit cards, car loans, etc., for stuff that just depreciates. Good debt is debt that creates leverage. It's money borrowed at a lower cost to help you acquire assets and earn a higher return. A mortgage can be good debt if you leverage wisely. Here's a Kiyosaki style perspective. Your 3% mortgage can actually make you richer. Sounds wild, right? But imagine this. You have a mortgage at 3% interest That's like paying an employee $3 to produce $100 of value. If you can take the cash you used to pay extra on the mortgage and instead invest it to earn it, let's just say 6 or 7% return, you are effectively arbitraging the debt. In plain terms, for every $100 of money, you paid the bank $3 in interest, but you earn $6 somewhere else. You net $3 profit on that $100 by not prepaying the mortgage. That's using debt as a tool, not as a curse. Why would you fire this cheap debt when it's like a worker making you money? Think of your low interest mortgage as an employee in your business of building wealth. If you have an employee, your mortgage that costs you $40K a year interest, but by freeing up capital helps you generate $80,000 a year in investment returns, that employee is giving you a $40,000 net profit. Why would you fire an employee who brings in more than they cost? Hell no. You'd be keep them employed as long as possible. Paying off a cheap mortgage early is like firing your profitable employee just to save on the salary. It's short-sighted. Kiyosaki's insights is to focus on cash flow and leverage. What flows into your pocket every month? How hard are your dollars working for you? A fully paid house gives you zero cash flow. It just saves you a monthly payment. But a low interest mortgage, paired with investments, gives you potential cash flow or growth and keeps your money flexible. Not even talking about the tax deduction on the interest rates. But let me be clear. I'm not saying run out of a bury yourself in debt. I'm saying strategize your debt. Use your mortgage as a tool while you build assets on the side. That's exactly what the wealthy do. They use OPM, other people's money, the bank's money, to get richer, to do what the banks do, not what they are telling you to do. It's time for you to do the same for your own home. Now, if you are feeling a little uneasy hearing all this, that's normal. Let's address the emotional side, the psychology. Why do so many of us have the urge to pay off the mortgages? Tony Robbins often talks about the 6 human needs. One of the biggest being certainty. We crave feeling safe, secure, knowing we have a roof over our head and no one can take it away. I get it. The idea of outright owning your home provides a huge psychological comfort. It's the, I am safe feeling. But Tony also teaches that the need for certainty can limit us if we are not careful. We can trade growth and opportunity for a false sense of security. And let me tell you, liquidity can provide certainty too, just a different kind. That is the certainty of I have no mortgage, but there is also the certainty of I have a fat emergency fund, investment fund that I can tap anytime. Most folks ignore the second one. Think of it this way. What's truly safer? Having $200,000 locked in a home equity in a paid off house, but maybe only $10,000 in the bank for a rainy day. Or having a $200,000 mortgage still, but also having $200,000 in liquid assets, saving investments available in life when life punches you in the face. In the first scenario, you feel secure until something goes wrong and you need money. Then you are scrambling, maybe taking a loan against the house you just paid off, assuming you can qualify. In the second scenario, you have options. You have peace of mind knowing that you can handle whatever comes. And you are still on track to own the house eventually. Tony Robbins would reframe it like this: avoiding pain versus seeking gain. Paying off the mortgage is often an avoidance move. Avoiding the fear of foreclosure, avoiding interest payments. Investing and staying liquid is a gain move. Seeking growth, abundance, upside. We humans tend to avoid pain more than we chase pleasure. It's hardwired. But to achieve financial freedom, We sometimes have to overwrite that wiring. We have to say, I refuse to make decisions just because they make me feel safe right now. I'll make the decision that actually makes me safe long term and propels me to my goals. It takes a bit of faith and courage. It's not as emotionally satisfying in the moment as sending the extra check to the bank and seeing your loan balance drop. But when you check the balance of your own ultimate fund, we'll get to that next, and see it growing, you get a new kind of emotional high: empowerment. The knowledge that you control your money, not the bank. The certainty that if something goes wrong, you got a cushion. The confidence that if you are on the path that very few have the guts to walk. That is real financial strength. So ask yourself, is your drive to kill the mortgage coming from fear or strategy? Is it about emotional certainty or actional financial optimization? I'm going to ask you one more time. Is it about emotional certainty or actual financial optimization? There is no judgment. We all been there. But if it's fear driven, recognize it and decide to operate from a place of power and strategy instead. As Tony would say, trade your expectations for appreciation and your fears for faith. Have faith in a plan that might be new to you, but has worked for countless others who took the lead. All right, let's ship into the solution mode. I turned down the old myth. Now I'm going to build you a new approach brick by brick. This is where my blueprint comes in. I call it the ultimate fund. It's essentially a strategy, max funded IUL, universal life insurance, as a wealth building tool. I know that's a mouthful. I prefer to call it the ultimate fund because to me, it's the ultimate way to save, invest, and protect your money all at once. Not a financial advisor, but I have helped thousands of people become wealthier and wiser. That is the disclaimer. I know my lawyers love it. But let me unpack this in plain English and with passion because I freaking love this stuff. Imagine an account that grows your money based on stock market gains without the risk of market losses. When the market index goes up, you get credit interest. When it goes down, you don't lose a dime. Your worst year is a zero gain, not negative. That's built-in downside protection. No stock, no 401k, we promise you that. What about compounds tax-free year after year? You are not paying off taxes on the growth every year like you would in a normal investment account. The money snowballs without Uncle Sam's hand in the jar. Tax-free compounding is unbelievably powerful. It's like your money on steroids legally. Lets you access cash when you need it without heavy penalties or a red tape. Need money for an emergency, a business opportunity, or to pounce on an investment. You can borrow against your IOL's policy cash value with just a phone call. No pleading with a bank loan officer, no credit check. It's your money. And when you set the terms of paying it back or don't paying it back all in your lifetime, it's up to you. We'll get to that and how it works. Meanwhile, your money can keep growing even while you borrowed against it. That's right. Through what's called policy loans. You can have your cake and eat it too. Your cash value stays intact, earning interest while you use the loan for whatever you need. This is how the wealthy use life insurance like their own private bank. Provides for your family if the unthinkable happens. It is life insurance after all. If you pass away, a death penalty, much larger than what you paid in, goes to your loved ones tax free, which can immediately pay off any remaining mortgage and leave a legacy. It's like the ultimate backup plan. You can sleep at night knowing that if I don't make it to the finish line, my family is still taken care of. Try getting that peace of mind from making extra mortgage payments. It doesn't happen. This ultimate fund is a max funded index universal life policy. Max funded means we stuff as much cash into it as legally allowed. IRS sets limits so it stays classified as insurance and the gains remains tax free. We are minimizing costs and maximizing growth. This isn't your grandpa's whole life insurance policy with big commissions and low cash value. This is a lean, mean wealth building machine. Now you might be thinking, Carlos, this sounds too good to be true. What's the catch? The catch, if we call it that, is you must have discipline and a long term mindset. You have to fund the policy consistently and give it some years to compound. It's not a get rich quick scheme, it's a get awesome rich in the long run strategy. Also, it needs to be structured correctly. Not every insurance agent knows how to do this right. There are moving parts, caps, floors, cost of insurance, etc. But when done right, the way I and my team at disruptorscode.com do it for our clients, it's a beauty. Think of it this way. Instead of sending extra money to the bank where it saves you 3-4% interest at best, you send the money to your ultimate fund where you could potentially earn, let's say, 6 to 8% tax free and not be locked up. You still pay your normal mortgage payment to keep the bank happy. All your extra goes into your fund, not the bank's pocket. Over time, this funds grows and grows. What do you think the bank do? That's what they do with your money when you put money and leave money sitting in the bank. What's the end game? A point in time where your ultimate fund has enough money to completely pay off your mortgage balance if you wanted to. And here's the kicker. That point in time will come sooner than the date you paid off the mortgage with extra payments. Why? Because your money is growing faster than the interest on your loan. It's compounding mightily in the policy while your mortgage is amortizing is slowly. We essentially hack the system by redirecting the cash flow. And all along the way, you had control. Need 10K for a new roof or medical bill? You didn't have to beg the bank or sacrifice your strategy. You tapped your fund and took care of it. Then continued on. Your plan stays intact. Your family is protected. And your money is working for you, not just saving a little interest. I call it the ultimate fund because it truly feels like the ultimate financial vehicle. It's your emergency fund, your investment fund, your retirement fund, and your insurance all in one. It's what I wish my parents had known about. What I shout about on stages now, it can change lives. It's contrarian, yes. It's not what your neighbor or even your financial advisor might tell you, unless they are in the know. But it's real and it's something the wealthy and savvy have quietly used for decades. Now I know it's a lot to chew on. You are listening and thinking, man, I wanted to learn more about this ultimate fund thing and how it applies to me. I got you. You can DM me the phrase ultimate fund on Instagram at Carlos Inspire. Just shoot me those words and I'll know it came from this episode that you want to dive deeper. I'll personally send you resources or chat with you about how to set up your own ultimate fund. No spam, no gimmicks. You know I am all about genuine connections. So hit me up, Ultimate Fund on IG. I love to help you get things going. You can also go to disruptorscode.com and watch a video there where I break down even further this concept. You can also book a time to talk to me on my private calendar there. All right, let's get back to the show. We covered the mindset and the strategy. Next, I wanted to zoom in out a bit to why flexibility is crucial in the world we are heading into. Let's get real for a moment. I know some of you are fired up hearing this, but some also might feel a knot in your stomach, thinking, this sounds great, but can I really do this? What if I mess up? What will people say? This is where I channel my inner higher self, a guy who's all about taking what pressures you and using it to empower you. Having a big fat mortgage can feel pressure, right? The weight on your shoulders. For many, it's the biggest financial burden in life. I often say, things don't happen to you, they happen for you. What if this mortgage pressure is happening for you? To push you to learn something new, to grow stronger, to become more financially savvy than you ever would have otherwise. What if this challenge is your catalyst to transform? Take the anxiety or stress you feel about the debt or about changing your approach and turn it into fuel. Fuel for learning, fuel for hustling, fuel for executing. Instead of lying awake at night thinking, how would I make these payments for 27 more years? You start thinking, how fast can I get my plan in place and beat the system? That's a mindset flip from victim of our circumstances to owner of your destiny. I often talk from the stage a lot about faith and vision too. Having faith that if you do the right things, believe in yourself, and don't give up, you will succeed. So have a little faith in this strategy and in yourself. You don't have to trust blindly. The math is the math. But if you do need to believe you are worthy of wealth and capable of executing a plan like this, you are. Trust me. If my immigrant bread selling a 7 self could eventually learn this and implement it, you can too. I wasn't a financial prodigy. I was a hungry kid who became a hungry student for financial success. Feel the pressure. Maybe it's providing for your family. Maybe it's proving you can break the cycle of living paycheck to paycheck. Maybe it's the pressure of being the one in your family to change your legacy. Now decide that nothing will stop you from turning that pressure into power. Let it a light, a fire in you. I get emotional about this because I know what's at stake. It's about more than mortgages and money. It's about freedom, breaking free from fear, and stepping into a life where you call the shots. I often say you are one decision away from a completely different life. Think about that. This strategy, this decision to handle your mortgage differently could be that one decision. The difference between retiring just a paid off house and a little else versus retiring with a paid off house and $1 million tax free account giving you income and security. One decision, radically different outcomes. I want you to imagine for a moment. Close your eyes if you can, not if you're driving. The day you make the final transfer and clear your mortgage years ahead of schedule. The day you lock in your ultimate fund account and see 6 or 7 figures, knowing it's yours, untaxed, ready to use for whatever dreams you have. Feel the pride, the relief, the power in that moment. You turn what it was once a 30-year shekel into an engine of wealth. You turn pressure into power. You became, as I would put it, the best version of you in the financial realm. That's something to smile about. That's something to thank God for. You are of faith. I know I would drop to my knees in gratitude. Many of my clients do when that day comes. Because you realize, damn, I did it. I broke the mold. All right, deep breath. I know we went heavy on mindset here, but it's important because all the strategies in the world mean nothing if you don't believe in yourself enough to take action. And I believe in you. You wouldn't be here investing your time in self-improvement if you weren't capable of greatness. Sometimes you just need someone to remind you of that. Let me ground all these story and theories and motivation into something tangible. A real life example. I wanted to share a quick case study from one of my clients. I'll keep his name anonymous. We'll call him John for privacy. John's profile: early 30s, married, 2 kids, decent income. He bought a home with $300,000 mortgage at 3% interest. Like many of us, in the beginning, he followed the conventional wisdom. He started making extra payments of about $700 a month to knock down the principal. He was proud watching the loan balance drop each month. His goal was to cut a 30-year term down to about 15 to 20 years. Admirable, right? When John met me, I asked him a simple question. After pay off this house in, let's say, 18 years by doing that, how much will you have in savings or investments from those extra payments? He blinked and said, well, the house will be paid, which is great. I pressed, but liquid cash, my friend, how much will you have that you can actually use? He admitted, probably not much, maybe a small 401k from work. But all our house money is going into the house. So I introduced him to the ultimate fund strategy we've been talking about. It took some convincing. His wife was skeptical at first, as expected. We had a couple of heart-to-heart Zoom calls laying out the numbers, but they decided to go for it. Here's what we did in numbers. Stop the $700 extra to the bank. Continue paying the required mortgage so credit stays pristine and the loan is on track. Redirected the $700 a month into a max-funded IUL policy, John's ultimate fund. We set it up with him as the insured, structure to minimize insurance costs, so he diligently contributes $700 every single month, automating it so I wouldn't even think about it. Fast forward 5 years, at an average interest crediting of about 7%, some years more, some less. 1 year was zero, but not a loss. John Cash value has grown significantly. He's put in roughly $42K, 700 times 60 months of his own money, but his account is not $42K. He's actually sitting around $55K tax-free accessible. Meanwhile, by paying just the normal mortgage, his loan balance has dropped from $300K to around $260K in those 5 years. So far, so good on both fronts. 10-year projected forward. John will have put in roughly $84K in premium. By then, if the policy performed moderately, let's even say a bit conservatively, around 6 to 7%, his cash value is projected to be around $120K or more. His mortgage balance after 10 years, no extra payments, will be roughly $220K. The magic is starting to appear. The gap is closing. He's got more than half of what he needed to wipe the mortgage already accumulated and growing faster each year, tax-free. At year 15, projected, this is where it gets exciting. By 15 years, John will have put in about $126,000 total into his ultimate fund, but thanks to compounding, he could easily have it in the ballpark of $230,000 to $250,000 cash value. Could be even more if the market does well, but let's just stay reasonable. His remaining mortgage balance at 15 years will be about $180,000. Remember, he didn't pay the extra, so the loan amortization schedule has it around there. Now picture this. John is 15 years older. His kids are teenagers. And he's got the full power to become mortgage-free right then. He can take, let's say, $180K from his $240K cash value via policy loan, march over to the lender, and boom. Here's your money. Goodbye, mortgage. He's now 15 years into a 30-year mortgage loan, and it's gone. Payoff achieved. But what does John have that he wouldn't in the traditional scenario? First, he's still got maybe $60,000 left in cash value, $250K minus the $190K loan, roughly. He's not zeroed out. He still has significant money growing for him, and note that. Second, he has access to money that the whole 15 years. In fact, around year 8, John did borrow about $10K from his policy to cover a family medical emergency. Had he been sending every spare dime to the bank, that 10K would not have been available. He might have to put it on a credit card or line of credit. Instead, he borrowed from himself, from his own bank, handled the emergency, and later paid his policy loan back. No harm done, plan intact. That's real life. Things happen, and he was prepared. Third, he has had a life insurance safety net the entire time. God forbid, if something had happened to John in those 15 years, his family would receive, let's say, 500K plus death benefit. They could have paid off the house immediately and kept the rest for financial support, which I teach families how to use that. Thankfully, John is alive and well, but that peace of mind was huge for him and his wife. Now compare to the alternate reality where John never met me and just paid the bank extra for 15 years. He would indeed have paid off the house by around year 15 to 18, perhaps with that $700 extra. I estimated about 17 years to finish. But in the year 15, in that scenario, that he would have maybe a few grand in savings, since all extra went into the house, no large investment account, no flexibility. If an emergency hit, oh well, hopefully equity loans are an option. And if he died during the payoff period, his family gets a house, sure, but maybe steal some loan if he hadn't finished, and no additional cash unless he had separately had insurance. And what about year 15 onward in our strategy? John now has a fully paid house and an ultimate fund that's still growing, minus what he used, but it can continue to grow on the remaining cash. If he doesn't pay it back, the 180K loan that he took to pay off the mortgage, when he eventually passes at, let's say, age 80, the life insurance death benefit will pay off whatever loan balance is left and is still delivering the rest to his family. If he does choose to pay back the loan over time, totally optional, the cash value will replenish and be even larger by retirement. Either way, he's far, far ahead of what he would be otherwise. This is real. These numbers aren't some fantasy. They are based on realistic scenarios I see with clients day in and day out for the past 20 years. And if we factor the cost of insurance and everything in those projections, the key is the spread. His money grew at a higher rate in the policy tax-free than the interest rate on the mortgage. That's the whole game. John's story is one of many. I've seen a woman in her 50s do with a refi. She took money out of her house, cash out refinance to fund an IUL, effectively moving equity from the walls to her wealth account, and end up in a position to pay off the house off and have a retirement income from the policy. I know many people are playing catch up on their savings and retirement. I see young couples start early and basically have the bank indirectly fund their future kids' college because the difference they invested will grow enough to cover tuition down the road and clear the mortgage. These numbers vary, but the core math always comes back. You can earn more on your money than your mortgage costs and do it all tax advantage way, you come out ahead, period. It's not magic, it's mathematics and patience. And John's example shows the patient isn't even that long. A decade or two, which you were going to spend paying a mortgage anyway. So why not end up with two assets, house plus a fund, instead of just one, just a house? That's the power. All right. I'm getting fired up again just sharing that. Because this isn't theory for me. This is personal. I'm sick and tired of seeing amazing hardworking people grind for decades, following the right advice only to end up with crumbs. No more. Not on my watch. This strategy and the others like is about to take back in control to your financial life. It's about beating the banks at their own game. You think the banks want you to do this? Hell no. They want you funneling all your cash to them like obedient little borrowers while they turn around and invest your money to make themselves richer. Tax-free. Flip the script. Become your own bank. That's the disruptor's code I live by. Question everything, even if a system is rigged against you, darn it, create a new system. I get emotional because I think of families, maybe like yours, where stress about money is a daily reality. The mortgage, the bills, the fear of what if one of us lose a job? What if? It doesn't have to be that way. There is a smarter way. A way to have true financial peace long before you are 65. But you have to be willing to challenge conventional wisdom. You have to be a bit bold, a bit contrarian, maybe the black sheep in your circle. And that's okay, because being a black sheep in a flock headed off a cliff is a damn good thing. Think about the legacy here. Many of us are immigrants or children of immigrants or come from humble backgrounds like I did. We weren't born knowing the secrets of the wealthy. I had to scrap and claw and learn from mentors, from books, from trial and error. And when I find something game changing, you better believe it. I'm going to shout it out from the rooftops from my people. My mission is to transfer this knowledge to as many open minded folks as possible. As I imagine a world where my listeners, my community, the disruptors, retire not just with a paid off home, but with generational wealth. Where their kids learn by example and break out of the paycheck to paycheck hamster wheel too. This is how we change our family trees, folks. Not by working more hours necessarily, but by working smarter and thinking differently. Picture yourself 15, 20 years from now. Do you want it to be the person who goes, I'm finally mortgage free? Now I hope Social Security and my small 401k can cover my expenses? Say it with worry. Or do you want it to be the person who says, I am mortgage free early and I have a portfolio of tax free income producing assets? I can travel, help my kids, start a business, whatever, because I plan for prosperity. Say it with a confident smile. That choice is being made right now, today, by what you do after hearing this. I know, I am intense. I get loud. I even scare some of you all with my passion. But it's only because I care. I care so damn much about not letting people become victims of a broken system. If being intense wakes you up, then so be it. Because the stakes are high. You're talking about your life savings, your home, your future. That's worth a sky-high level of passion. This is your visionary stuff if you embrace it. You are effectively looking at your life, general mapping out a war strategy instead of a foot soldier just taking orders. You are anticipating, you are strategizing, you are making moves that 99% of people don't make. And that's why 99% of people don't have exceptional results. Be the 1%. Even if at first you are the only one in your circle doing it, own that. And your neighbors or family scratch their heads and say, why aren't you paying off your mortgage faster? Just smile internally, knowing that you have a secret weapon they don't. One day you show them the results. I often say this on the show. Pressure is a privilege. Do you feel pressure right now? Pressure to change your finances? Pressure to secure your family's future? That means you have something worth fighting for. Use that privilege. Fight for it with knowledge and smart action. That's how you honor the struggles of those who came before you. I'm thinking of my parents, my grandparents who had far less information and opportunity. We owe it to them and to our kids to break free. Everything we discuss, the big lie, Dalio's principles, Kiyosaki's leverage, Tony's psychology, and the motivation of why we are even doing this. All it comes down to this. You are taking charge and not settling for ordinary. This is your life, your house, your money. You get to decide how to play the game. And if I am giving you permission to play it in the way that benefits you, not just the bank, not just the system. Because at the end of the day, it's not about mortgages or even money. It's about freedom. The freedom to live life on your terms, to not lie awake worrying, to be able to say yes to the experiences and helping others because you are not chained by a paycheck or a debt. I have a vision for you. Yes, you listening right now. Maybe we meet someday and you tell me, Carlos, I took that crazy advice of yours. I did it. Paid off my mortgage in 14 years, and my ultimate fund is now bigger than the remaining balance ever was. My family is set. We are good. You're actually looking at about buying a rental property now with the extra funds. Or maybe I'm starting that business I always wanted to, completely stress free. Man, if even one of you says that to me in a few years, I'll probably cry on the spot and give you a big, bear, giant hug. That's what this is about. Real people, real lives change. All right, I'm going to wrap up here before I blow a fuse with excitement. But listen, knowledge without action is worthless. You've been taking the time to listen and learn. Don't stop here. Take action. If you are unsure where to start or you want guidance, remember my offer. DM me the words Ultimate Fund on my Instagram account at Carlos Inspire with a check mark. Let's chat about your situation. No judgment, no strings attached. I genuinely want you to win. If I can shortcut your learning curve by pointing you in the right direction, it would make my day. Also, check out disruptorscode.com. I named my site and movement Disruptors Code because it's about cracking the code that keeps most people ordinary and disrupting it. On the site, you'll find resources, videos, training about strategies like this. Basically, a treasure trove for folks who want to break free out of the mainstream financial trap and do things differently. There's a video there that you can watch. There's a link to my private calendar, disruptorscode.com. Remember, you have a choice. You can continue to be on the slow, safe path that most tread, or you can take the smart road that's a bit less travel but leads to wealth and freedom faster. I think you know which one I'm advocating for. I've walked it, I've guided thousands of others on it, and now I'm handling you the map. The rest is up to you. Thank you for listening to the Carlos Inspire Show. If this episode lit a fire under you, do me a favor. Share it with someone you care about. Don't keep this information to yourself. Spread the wealth literally. We rise by lifting others. Maybe it's your sibling, your best friend, your brother-in-law, your sister-in-law, your colleague who's stressing over their mortgage. Send them this episode. Tell them there is a better way. Let's build a ripple effect of financially empowered people who, one, won't settle for less than the status quo. As always, stay strong, stay blessed, and stay inspired because you know it. Life is all about the mission, never the commission. And the days that breaks us are truly the days that makes us. This is Carlos Cicada signing off. Now you go out there and disrupt the game and build your ultimate life. Até a próxima. Ciao. Until next time.